$16 trillion in negative yielding debt. How much has CalSTRS benefited from the monstrous rally that we've seen in fixed income versus senior future liabilities driven higher?
Yeah, it's amazing. When you look at the return of the 30-year government bond so far this year, over 20%. I mean, that's staggering. But that's been driven by the fact that Europe and Asia have negative rates. So we're not buying into those markets. We're not buying into negative rates. But we are owning U.S. debt, and it's helped our portfolios. From the standpoint of the funding of the pension plan, everybody had a very decent single-digit return last year. So our funding actually is going to continue to improve slightly.
There's talk amid this rush for any sort of yield and the rampant demand for longer-term debt of a 100-year bond, something that Mnuchin is looking at very seriously. Is that something that would be attractive to yourselves?
You know, Carolyn, in our case, we talked about that today. Glenn Hosokawa and Rosie Lucasini-Jack, who run the fixed income and the government desk specifically, will consider it. But, you know, I just laughed when I heard about that this morning on Bloomberg Radio, because to me it was, here's Trump, a real estate guy, always wanted to put on more leverage. And I have to say Mnuchin's correct. If the U.S. government's going to borrow money for 50 to 100 years, boy, now's the time to do it when interest rates are so darn low. But the challenge with those bonds, they're usually a little bit interesting to insurance companies, people with long-dated liabilities. The yield is going to be so low, and to get technical, the duration of those securities isn't going to be that long term. It's going to be a little bit more duration than a 30-year bond. I think the trading volume is going to stay at the 30-year bond. So it might get some interest. Not a lot from the pension plans, but a lot more from corporate plans and from insurance companies.